And we'll just give everybody another minute or so to get in, but we're seeing folks trickle in. All right, I think we'll get started. So we just want to welcome everybody to our mid-year update on women and minority-owned private equity and venture capital firms. This is the second year we've done a mid-year update like this on this segment of the market. Much of the content that you'll see today is an extension of a fuller report we publish annually, which we have been doing so for a decade now. And obviously, this is an area of the market that's really important to us, one that merits some discussion. All the things we do at Fairview, serving emerging managers, inclusive of diverse managers, has really been one of our core pillars since day one of the firm, which is now 30 years ago. And today, I think we all feel like we're at a pretty critical juncture. So we think this will be an important session. We have a great mix of LPs and GPs in attendance today. And we think there'll be some really good content that can hopefully be helpful really to everyone in and around the ecosystem. And we do want this to be interactive as well. So let me first introduce the Fairview team. I'm Amakar Vachani. I'm a managing partner at Fairview, and I'm joined by my colleagues, Kwesi Kwe, who's a partner at Fairview, and Michelle Chow Tai, who is our managing director of business development. In terms of what we will cover today, we'll start with a brief overview of Fairview for those of you who may not be familiar with us, and then we'll jump right into the data. We're going to give everyone a full download on what we've observed through the first half of this year. Then we'll talk about implications for both LPs and GPs, and we'll also share an outlook based on everything that we've seen. And then at the end, we're hoping to do a Q&A for about 10 to 15 minutes at the end so that it is more interactive. So we ask attendees to ask questions throughout the session using the Q&A function, and we'll try to get to as many of the questions as we can. I remember last year we didn't get to every question, so we ended up following up directly via email or meetings with those that we didn't get to, or topics that ended up requiring more discussion. So we'll do the same thing again this year. And as always, we have an open door. So if there's anything you think of afterwards or want to dig into, feel free to reach out to any of us. So with that, let me pass it to Michelle for a brief overview of Fairview.
Thanks for that, Akar, and welcome everyone. Delighted to be here with you. And so just to give you a brief overview of Fairview, Fairview's an independent SEC registered private markets investment firm. We've been serving institutional investors now in this capacity for 3 decades and have grown to a capitalization of $10.8 billion since our founding. Our specialist investment approach really focuses on key areas within the private markets where strong relationship, access, market intelligence, decisive decision-making, agility are all critical to achieving success. We're deeply embedded in the private market space. We have experience, given our tenure, navigating and thriving through multiple market cycles. And many of you are aware that New York Life acquired a minority interest in Fairview this year. Here, we engaged in a unique win-win opportunity with a client where the firm maintains its independence indefinitely. New York Life gets access to an offering they didn't have before, and it supports a generational and ownership transition of the firm. So we are just super excited about this transaction. We believe it will create even more opportunities for Fairview and our clients, given New York Life's past distribution capabilities globally, and also being America's largest mutual life insurer. On the next slide, so how do we serve our clients? Well, for nearly 3 decades, Fairview has consistently is in a position of trust and reliability in the private market space. Our established reputation as a go-to partner has allowed the firm to provide access to highly sought after managers in the venture capital and growth equity space. With respect to how we serve our clients, one is investing in best-in-class next generation and diverse managers. And this practice invests in experienced managers, which are newer, smaller firms. There's often an overlay of diversity here. Another is investing in top-tier, difficult-to-access venture growth equity funds. And we've been investing in this segment of the market for 2 decades. We do co-investing in both of these areas, and we serve a broad base of limited partners through our commingled and customized accounts, who many are participating in this webinar today. I'll pass it on to Akar to double click on Fairview's Diverse and Emerging Management Program. Thank you.
Thanks, Michelle. Yeah, just to give a little more context about our work in the emerging manager space. So we raise capital specifically to invest with emerging managers. That's inclusive of diverse managers. 30 years almost of doing this. So Fairview was really the first fund of funds with this focus. And so we're fortunate to have an incredibly rich history and experience and data set to lean on. We believe we've probably been the most consistently active organization with emerging managers over the last 30 years. And the belief and experience has always kind of been that the best, newer and smaller firms will outperform, and that diversity of thought and perspectives will also lead to better outcomes. We have seen a lot of LPs come and go in this space over the various cycles. Often see a lot of opportunists, but it's a space that's hard to do well and consistently, and have that dedication it takes to serve the ecosystem. We're fortunate that we've had the steadiness of engagement and an investment activity and results actually that over time have become a big advantage to Fairview, including in building the data that we'll share today. And as Michelle said, I also just want to add that we are selective in our mandates, but we are fortunate to have some great LPs like the ones pictured here. And all the work we do is only possible because of the belief that some of the most sophisticated institutional investors have had in us. That includes some of the best pension plans, corporations, insurance companies, foundations, and endowments in the world. And we always view it as a privilege to positively contribute to organizations like these here and many others that we work with. And I see a bunch of you all are in this session, so thank you for your partnership. So if you take the investors we work with and the firms we back, we are very fortunate to sit at this unique intersection in the private markets. We believe this is one of those markets where you have to be all in. You have to know as much of the market as possible if you want to be successful as an LP. And the dispersion of returns can be high, which means, for us, market coverage and manager selection matter a lot. And this is not specific to diverse managers, but really all emerging managers in general. That's why we built what we believe is the largest database in the industry. That's also why we take a prepared mind and thesis-based approach to investing. We think this is critical when you're trying to tackle what we think is one of the most dynamic, complicated, and consequential segments of the market. And why we share our data is pretty simple. We only really succeed if the ecosystem succeeds. And so we view that as part of our responsibility, given the history that we have in our role in the market. A little bit about the data that we're going to present today. We'll be sharing data that is specific to women and minority-owned firms. This is our own proprietary data. It'll cover firms that have been in the market raising capital this year, 2024. This is essentially the opportunity set that exists for LPs today, especially those who are interested in being more inclusive or investing more intentionally with diverse managers. There are a lot of different definitions out there, but for us, we are very focused with this data set, and we're including only firms that are majority woman or minority owned, and those that are based in and investing in the U.S. A few final notes before we get into the data. If you take a step back and look at the universe of women and minority owned firms, we are in somewhat uncharted territory today. Obviously, these firms continue to be pretty severely overlooked despite the growth in the opportunity set, which we'll talk about. But really just a small fraction of the industry's AUM still, no matter how you measure it, of course. But there has been a lot of growth in recent years. And, this segment of the market at the scale it is at today really has not been tested in the way it's being tested now. The backdrop has certainly changed with the low interest rate environment gone, capital becoming harder to come by. You add to that attacks on diversity that we've seen. And then LPs have generally just taken a flight to perceived quality, which tends to be larger, more established platforms. That's often at the expense of emerging managers. And this is quite frankly not atypical. We've been through these emerging manager cycles before, and they tend to always have an outsized impact on emerging and diverse managers. But we do find that this time through, the opportunity remains very dynamic, and based on what we're seeing, it's relatively resilient. But what is different again this time is that the scale and the scope of the opportunity set, just the number of LPs and GPs who are involved. So with that backdrop, I'll hand it off to Kwesi to pick up from here and take us through the data.
Sure, thanks, Akar. And so at the highest level, the universe of women and minority-owned firms continues to grow despite changing market conditions. It's worth noting that in 2014, there were just over 100 women and minority-owned firms in the industry. And at that time, the barriers to start a new firm were much higher than they are today. Many new firms launched at that time were buyout strategies, and general partners were classically trained. And what I mean by that is that diverse general partners spent time in investment banking roles, rose up the ladder at venture capital and private equity firms, and then took best practices to build a fundless sponsor or a proof of concept track record. It was only after that firms would formally launch an institutional fund. And so that is, by all accounts, along an arduous road. And I haven't even touched on the upfront cost to open up an office, hire talent, and develop a robust infrastructure environment. But fortunately, over time, over this period that we've been externally reporting the data, we've observed advances in technology. Startups' costs have come down. There's been increased demand for venture capital strategies in particular. And there's just lower barriers to start a firm today. And this confluence of factors is what's driven much of the long-term growth that you see over the last decade. So looking at the chart here, you can see that the growth was most pronounced beginning in 2020. Recall at that time, the global pandemic and high-profile injustices brought unexpected and extraordinary challenges. This accelerated the demands for inclusive investing in women and minority-owned firms. But that's now 4 years ago. Institutional investors who were just beginning to intentionally invest in the space made their initial allocations. And those new firms that started post-2020 are now re-entering the market. Also, we have to consider the macroeconomic backdrop. It's much different now. In an environment with record low interest rates, private market strategies, namely venture capital, growth equity, and buyout funds, were in high demand. So what's the data telling us this year? Well, the data shows strong growth despite changing market conditions. Through the first half of this year, Fairview is tracking just shy of 1,000 women and minority-owned firms, meaning the universe has grown almost tenfold over the last decade. This reflects a 24% CAGR, which is indicative of strong firm formation over several years. And moving to the next slide, we're going to double click on what we're seeing, this year. So through mid-year, you can clearly see that firm formation remains robust, despite a more challenging fundraising environment. It's important to note that launching a new firm is a significant endeavor and can have a long lead time between the ideation and launch phases. So it'll be interesting to see the opportunity set during the balance of the year. What you see here are the annualized results based off of the mid-year data that we have. And what's clear here is that the new firm formation is on pace to exceed the record set over the previous 2 years. Moving to the next slide. A question we often get asked at Fairview is what is driving the growth in the universe of women minority-owned firms? We think there's 4 main reasons. For one, we continue to observe increase in diverse talent entering the industry with operating and investing backgrounds, and that's inclusive of angel investing. Second, maybe many diverse professionals experience limited career advancement, at tenured firms. This has led some to build the conviction to start their own firm. Our observations confirm limited career advancement continues to be a challenge, which could bode well for new firm formation. In particular, in this market cycle, we're seeing top-notch, senior-level, diverse professionals spinning out from tenured firms. Many cite the tenured firms have simply gotten too large. They're focused on late-stage growth opportunities. The consequence is that early-stage investors are now forced to establish their own firms. So this is a tailwind for LPs looking to back the next generation of difficult-to-access firms. The third point I would make here is that, diverse managers are invigorated to develop a new firm with an inclusive first culture. Diverse managers are reshaping the industry, grounded in the knowledge that cultures that truly embrace diversity, equity, and inclusion can outperform. We think organizations that have embraced inclusion are advantaged, recruiting diverse talent and are building strong brands with this philosophy. And they're also able to uniquely connect with LPs, GPs, and founders who share affinity groups and values of the same. Lastly, and we've touched on this, but there are lower barriers to entry given the advances in technology and reduced startup costs. So these 4 things have all explained why the opportunity set has continued to grow, even in the face of changing market conditions. Moving to the next slide. All told, 376 women and minority-owned firms are in the market this year. That's actually up from 325 during mid-year 2023. So that's a 16% increase. Continuing recent trends, diverse managers represent newer firms, they're targeting smaller fund sizes, and they're primarily focused on venture capital strategies. Importantly, 65% of those firms in market are continuing a fundraise from last year. So that's indicative of the longer fundraising cycle that we're all experiencing. In the first half of 2024, first-time funds sponsored by women and minority-owned firms represented 49% of the women and minority-owned firms in market this year, which is a decade low. We think there's a silver lining here, and what that means essentially is that most firms are now raising successor funds and are presumably building their franchises. But from a fund size perspective, the universe is targeting $100 million. That remains unchanged from the last year. And from a fund strategy perspective, 75% are raising a venture capital fund, and that's up from 72% in the prior year. So digging into fund sequence, which is on the next slide, you can see that most diverse managers are now raising a successor fund. This year, highly sought after diverse managers with strong track records quickly re-entered the market. We've also noticed that managers are increasingly pre-marketing and holding multiple closes in anticipation of longer fundraises. Moving to the next slide, when we look at the fund size, as mentioned earlier, the median fund size for a women minority-owned firm in the market this year is $100 million. However, when you compare that, to the industry median is 4 times that. So there's a huge spread between what diverse managers are seeking to raise and what their broader market is ultimately raising. We know that diverse managers, often do not meet minimum size parameters implemented by institutional investors and their intermediaries, including for many emerging manager programs. So as such, LPs may be inclined to invest in larger funds sponsored by established firms, and that is a headwind for diverse managers who may be overlooked. Moving to the next slide, this slide really emphasizes the point that the universe is predominantly raising a venture capital fund. The barriers to entry are simply lower in venture capital when you compare it to growth equity and buyout funds. Growth equity and buyout funds often raise larger funds. They write larger checks, and they generally require significant infrastructure investment and talent investment upfront. Additionally, track records can be harder to generate because one must often rise to a senior role at an established firm. Conversely, in venture capital, we have observed track records developed through smaller proof of concept venture capital funds and angel investments, both of which have lower barriers to entry. Looking at the chart, you can see that growth equity has hovered between 10 to 15% of the funds in market over the long term. And when we look at, what strategies, diverse managers are pursuing, they're often pursuing technology, infrastructure, special situation strategies as well. Moving to slide 18 now, let's look at, some of the demographics. So beginning, with African Americans, we're seeing a growing proportion of African American owned firms raising a successor fund. That is in itself an early indication of the emergence of more enduring African American owned firms. And that's a good thing. Now, when you look at it from a fund strategy perspective, approximately 73% were raising a venture capital fund, 14% were raising a buyout fund, and the remainder were targeting growth equity and other strategies. African Americans were targeting a median fund size of $70 million, which is actually down from $75 million in the prior year. So when you compare African Americans to the broader industry, which is raising north of $400 million, when you compare them to the universe of women minority-owned firms, which is $100 million, African Americans are even below that. Looking at Latinx firms, it's another story there too. When we look at the universe of Latinx firms, they're severely underrepresented, relative to other demographics. However, 60% are raising a subsequent fund, which is up from 49% last year. So there are early indications that some are building out their teams and growing their franchises. Interestingly, about 21% are raising a buyout fund, and 8% are raising a fund 4 or higher. So although there are not that many Latinx firms in market, those that are in market appear to have some staying power. Shifting to Asian Americans, which is on the next slide. Most were in the market with a successor venture capital fund. In fact, 79% of the Asian American firms in the market were raising a venture capital fund, which is the highest of the profiled demographics. And in terms of median fund targets, they're raising $100 million. This is important to note because although many Asian Americans are raising a successor fund, one would think that this would apply a step up in fund sizes, but we find that Asian Americans are still targeting a fund size in line with other underrepresented demographics. Moving to women-owned firms, and we have various demographics within this, all tell slightly different stories. At the highest level, our observations confirm that women-owned firms often raise small, early-stage venture capital funds, while African-American women and Latinas are raising the smallest funds. So when we look at African-American women-owned firms, 75% of African-American women-led firms were raising a first-time fund. 83% were raising a venture capital fund. And they're targeting a $30 million median fund size, which is down from $50 million from the prior year. So that's a sharp step down, but that's largely driven by a handful of managers that were raising larger funds last year as compared to this year. When we look at Asian American owned firms, 80% were raising a venture capital fund. Most were raising a successor fund, and they're targeting an $85 million median fund size. Latino-owned firms are very underrepresented. All of them were raising a venture capital fund. So as far as we know, as of this point, we are unaware of a Latina raising a growth equity or buyout fund. If any are in the audience, please reach out to us. We want to talk to you. And when we look at it from a fund size perspective, Latino-owned firms were targeting a $50 million median fund size, which is up from $35 million. So when you look at women, they're raising the smallest of funds. And, it's certainly a different environment when we look at it, even compared to last year. And lastly, when you look at non-minority women, 78% were pursuing a venture capital strategy. Most were raising a successor fund, and then they were targeting a $75 million median fund size. So at the end of the day, you're looking at median fund sizes less than $100 million. The opportunity set is clearly with venture capital funds. So when we look at, the next slide, we're going to shift a little bit to what we like to call, the multiplier effect. And so given Fairview's positioning in the marketplace, we have amassed a unique set of data on diverse managers and their underlying portfolio companies. This slide is real examples of 3 active Fairview Fund of Funds focused exclusively on investing in funds sponsored by women and minority-owned private equity and venture capital firms. And importantly, none of these Fairview vehicles, nor the sub-funds in the vehicles, have an explicit strategy of investing in women and diverse entrepreneurs. But what's clear here is that there's a natural diverse multiplier effect, such that at the portfolio company level, diverse managers are investing in diverse entrepreneurs. And in the 3 vehicles, over 2/3 of the portfolio companies you can see are led by women and minorities. So what's evident is that diverse managers are organically tapping into their differentiated networks. And we continue to see deliberate approaches to investing in diverse entrepreneurs over time. And now I'll turn it over to Michelle to share some additional observations on the fundraising environment for diverse managers.
Thank you for that, Kwesi. So this slide really speaks to some significant trends that we are seeing in fundraising activity. And so there's been a decline in commitment activity across venture capital and private equity compared to previous peak levels. We're seeing a shift in some investors' behavior and preference away from venture capital and to a certain extent away from private equity for various reasons. Beyond the sentiment shift, though, some LPs have veered away from venture capital and private equity due to liquidity constraints. And during market shifts, we find LPs tend to gravitate towards larger, more established firms rather than emerging managers. And so we're also seeing that programs that were designed to support and invest in new and emerging managers are less common now. It's almost as it was a point in time, which consequently is limiting opportunities for new and emerging managers to secure funding for launching and growing their firms. We find that many LPs lack the capacity or experience to effectively navigate the expanding growth, the complexity, and the changing landscape of investment opportunities offered by emerging managers. Additionally, LPs who are actively involved in investing tend to prioritize maintaining and nurturing their current emerging manager relationships over seeking out new relationships or opportunities. But the silver lining here is that more LPs are recognizing the value of deploying their capital consistently, especially considering the favorable investment opportunities available in the current market. And so with that, I'd like to pass it on to Kwesi to discuss key considerations for LPs.
Thanks, Michelle. So, when we think about the 2024 vintage, we know some things, right? We know valuations have come down since the 2021 highs. Founders are laser focused on growth at a reasonable cost rather than growth at all costs. Competition for assets has generally come down, and the innovation that lies ahead are attractive elements for private market investing. And venture capital, growth equity, and buyout strategies, as we all know, are long-term asset classes, 10 plus years, in fact. And so with that backdrop, we know that market timing is really a fool's game. And sophisticated LPs with long-standing emerging manager programs recognize the long-term benefits, in their portfolios. History and market dynamics really indicate that now is a favorable time for emerging manager investing. In our experience, a consistent, programmatic, long-term approach has been proven to be accretive to institutional investor portfolios. But indexing, inefficient markets comes with risks. Dispersion of returns has always been high, particularly in venture, where diverse managers often prosecute their strategies. So one really must identify and invest with the top GPs. And fortunately, we're in an environment where we're seeing high performing, diverse talent spin out, team up, and learn best practices on someone else's dollar. But, to take the other side of that, an inclusive pipeline, an unbiased approach is as important as ever. We know that the best managers may come from non-traditional, non-obvious backgrounds who look at the world differently and can uniquely connect with the next generation of founders. So now let's address the elephant in the room. Some LPs are capital constrained. It's real. Distributions in the market have slowed since 2021, and allocators, at least in the short term, are adjusting to higher interest rates. But even still, LPs can still be helpful. Our counsel would be, take meetings, provide useful feedback, refer managers to other LPs in your network, and really seek to build authentic relationships for the future. Also, really make room for new managers. We've talked a little bit about, this perceived quality of re-upping with, tenured managers, longstanding managers, established managers. But we know that the talent that will drive the best returns, it's not static, and it is in fact evolving very quickly. And, we can't have a webinar, just to kind of pivot a little bit here, but we can't have a webinar without talking about AI. So let's just talk about it. We at Fairview have published white papers on the topic, the earliest of which was, well before 2020. It's on our website, and, before all the hype that you read about, today. And, in short, we at Fairview believe that the AI opportunity is real. The market is large, the market is growing, and we fundamentally believe that it will transcend many industries. But, that said, be careful. We should all be careful. Experience, networks, technical knowledge, and company building experience matter a lot. And think about your networks, your friends, your closest friends, the universities, all the folks going to study, we have a shortage of people that actually truly have that expertise in AI machine learning. And so it's very easy to have aspirational goals around investing in AI, but you need to have the networks of people. You need to be able to access those founders. You need to be plugged into those ecosystems. And that technical talent is really hard to come by. And that's also why you're probably seeing a lot of these AI companies that have established teams that have deep technical knowledge get the valuations that they have. It's really an information and talent advantage that a lot of investors are paying up for. And so with that backdrop, you know, the GPs and the companies in this space really have a talent advantage, which is simply not replicable and as available for the tourist investor. So just a word of caution on that, but we do believe in that opportunity and we are programmatically investing in the space. And now I'll turn it over to Akar to share some considerations for GPs.
Thanks, Quasi. Yeah, we are seeing a lot of emerging firms in the AI category too. So kind of double reason if you're focused on this category to be careful. But yeah, some key some key considerations for GPs based on what we're seeing. I think we have a lot of GPs in the audience, so hopefully this is helpful. But the first observation is that it is very clear that the bar has risen. We think that's fairly universal across the LP landscape. So you really need to demonstrate unique elements of what you're building, like what makes you elite. Because the firms that can demonstrate they are elite at what they do are the ones that we are seeing getting the most traction in the market right now. And then the thesis and strategy you're pursuing, should really be honed and specific. I think, it's okay to be a generalist. In fact, that can be a positive thing, but the more clear you are about your thesis areas and how you connect that to your experience and your networks, and the clearer those connections are, the more comfortable LPs will be. We're seeing LPs spend a lot more time evaluating that dynamic. And then we should also add here that diversity should more complement a strategy. It can still be led with, if that's the differentiator, but either way, there needs to be more behind it if that is part of the focus. In terms of raising capital, cold pitches leading to commitments in short periods of time, like that just really is not happening anymore. Hasn't been the case for a couple years, outside of maybe a handful of groups. So you really need to lean into relationship building, which takes time. You need to lean into the LPs that have belief and will write a belief check, so to speak, especially if you're kind of early in your fundraising journey. And we would also say that even if an LP doesn't invest right now, not only is that relationship building important for the future, but as we kind of alluded to in terms of the advice we gave LPs, we also think there's value on the GP side to meeting with LPs who can provide that valuable feedback. And ideally for that, you want to look for LPs that are experienced and that have been active. Some more thoughts here on the next page. We are finding that there's some mergers of teams happening across the ecosystem. That activity has clearly picked up over the last year or so. We think it can be positive if it's done right. The other thing we will add is that we do find a lot of our peers are still not comfortable with sole GPs. It's an added risk or a perceived risk, and so in addition to that, we usually find that having more than one person to help raise a fund and build a firm can be really helpful. So GPs may want to consider that route in terms of teaming up, but it absolutely has to be done in the right way, and the fit has to be really tight. For some GPs, we are seeing really shaky fundraising prospects for new firms given the environment. Even if they're talented operators or talented emerging investors, there are some GPs in this situation where we're counseling them to kind of focus more on building a track record in any way possible, whether that's taking a role with an established firm for a few years or going to take a different route in terms of the fundraise, so raising maybe a smaller proof of concept fund first, or doing deals on a deal by deal basis. Whatever the right path will be different for each person or team, but sometimes it makes sense to consider those alternatives. The other thing we're seeing is a little more of some LPs taking advantage of firms who are in vulnerable positions by trying to extract unfair terms or push for GP stakes. Usually there, we advise firms to be really careful and try to avoid compromising on that front, because there are pretty significant risks to firm building that get introduced if you go this route. So things like alignment and incentive get messed up. There's also a negative signaling risk to worry about. So again, tread carefully when you're approached with those kinds of offers. And then finally, it's not all gloom and doom. I think finally some words of encouragement. I think, I guess hopefully if you've started a firm, you've done it because of a deep conviction that you've had. And, you have to lean into that. If it's strong enough, you will find a way to weather the challenges. It's never been an easy industry, and persistence has always mattered a lot, no matter the market conditions. And you do need to have a long-term outlook. That's been a consistent theme today, because the markets will evolve and they will change often, throughout your journey. We just happen to be at a certain point in the cycle, but whatever you are building should not be bound to cycles, right? And then lastly, we encourage getting involved with organizations that serve and advocate for emerging managers and for diverse managers. Just the support alone you get from those organizations is really worth it, not to mention all the other resources that can be accessed. We're active with a lot of these organizations, and we're happy to make introductions and connections. So if you're interested, feel free to reach out. And then finally, just to wrap up, we summarized here an outlook for the balance of the year. We do expect the new firm formation that we've highlighted to continue, and that we do think that the quality of managers will actually continue to go up. And part of that is because in the types of market conditions that we've been in, usually only the most motivated, higher conviction managers are likely to start a new firm. And that does feel pretty evident right now. It's not universal, but I would say by and large that's been a noticeable shift. That's also not to say fundraising will be easy. We kind of expect a bifurcation of sorts, which we're also already seeing, where the diverse managers with existing LP bases and good track records are usually able to raise successfully, more so than newer firms. Obviously that dynamic is normal, but I think the difference is that the gap between newer firms and higher quality funds, 2s and 3s and beyond, will probably widen. Another gap that could continue to widen, unfortunately, is a difference in the ability to raise capital relative to the broader market. Usually we find that conviction in emerging managers is the last thing that comes back for LPs when we go through cycles like this. So this trend will likely continue for a bit. I talked a little bit about combinations of teams, and we expect that to continue this year. And then lastly, we think a bigger unlock of capital, given how much of the emerging and diverse manager market is in venture, will likely come when the venture market turns, particularly in terms of exits, which probably is not likely until sometime next year, but it will eventually happen. So with that, we've been seeing some questions come through this session. I know we're kind of pushing on time, so we'll try to get to a few questions. We'll have Michelle moderate the Q&A portion, and then, like I said, we can always address questions directly after the fact.
Yeah, thanks for that, Akar. And I just want to remind everyone, if you have a question, just put it in the Q&A so we can address it for you. We do have one. It's from William White. Well, welcome, William. And his question is, what's the outlook for emerging women and minority-owned fund managers in consideration of the geopolitical climate towards DEI?
Yeah, that's a tough one. Question we get all the time. I think there's a couple of noticeable shifts. I mean, one thing that we are seeing is that the managers that maybe were focused exclusively on investing in women and or minorities, like if that was their focus, they're maybe shifting that or softening the language around that. And that's really in response to the Fearless Fund lawsuit, right? Like trying to avoid being targeted in the way that firm was. But otherwise, as Kwesi pointed out in the slide that showed the multiplier effect, it doesn't seem like anyone's abandoning investing in, people in their network that happen to be diverse because of these attacks on DEI. On the LP side, I think it's a little more complicated. When it's such a diverse mix of LPs, and each one of them has different situations. Private corporations and foundations, endowments, family offices can generally do what they want to do. The question is like, how much pressure do they feel? How much is it getting to them? And on that front, I think it is a mixed bag, quite frankly. Some are pretty noticeably leaning away. Some are actually leaning in. So I think that's yet to be seen exactly how that's going to play out. But there definitely there has been a chilling effect there. And then when we look at pension plans, I think that really varies state by state, municipality by municipality, in most cases, depending on local statutes, which may have been in place when emerging manager programs were formed and kind of, have been implemented into those programs. So at that level, I think things will change slowly. But again, it does vary a lot depending on where you're located.
Thanks for that, Akar. Another question from James J. Aurora is, there are a lot of great resources for seed stage emerging managers, but not a lot for growth stage VCs. Any recommendations?
Yeah, I could take a stab at that. And maybe just to kind of paint the landscape as to perhaps why there are more resources for seed stage firms is because the ecosystem today is primarily that. We actually didn't touch on this in the data, but we know that, within venture capital, close to 90% are focused on early stage. So that includes, seed and Series A. And so, quite frankly, there's not that many late stage VC firms when we look at it, from the women minority owned universe here. But those that have gone on to raise late stage funds primarily started as early stage funds. And so there's a natural maturation that needs to occur, I think, for the ecosystem to see more of those types of firms. But to answer your question, head on, I think it's important to kind of network with some of those managers that started as early stage VCs and that now raise later stage funds. And there are certainly some that come to mind. It's also important to talk to other managers that are in the space that may or may not be diverse. There's a lot of best practices, that can be learned. Many of them put out white papers and thought pieces. There's conferences, ecosystem events. So don't just go to like the diverse and emerging manager circles, but really kind of force yourself to go to wherever there's thought leadership within the venture category. And my guess is you'll be able to find some resources.
Thanks for that, Kwesi. We have an anonymous attendee. They're really looking to find out when the 2024 report will become available, and what would be the best way to size the overall market here. And, what's the opportunity to get access to names of funds in the space?
You want to go back and forth? I can take it. And then Kwesi can chime in if he wants. But yeah, the 24 report will come out early 2025. That's usually the cadence, so like January, February. In terms of sizing the market, we did kind of do a little bit of that in the 2023 report. And if I recall correctly, I don't have it in front of me, but essentially diverse managers were targeting, I think, around 5% of the capital that was being targeted by the entire private markets. And in terms of the amount they actually raise is probably a little bit lower. So that gives you a sense of that. And then can we get access to the names of all the funds in the space? We typically don't share that because often, one, the data is proprietary. Often we have signed confidentiality agreements with a lot of the GPs we get data from. So we try not to, but depending on the use case and what it is, we're happy to share kind of additional characteristics of the market or specific examples if it's helpful.
Thank you for that, Akar. Well, we have a ton of questions. Kay Haywood is curious about whether or not you can share the data around performance.
Yeah. So we don't have the performance of the entire market, but one of the things that I would refer Kim to is the NAIC actually publishes a study where they, for all those members that are part of the NAIC, they self-report and aggregate the performance of the diverse and emerging managers across various strategies, venture, growth equity, and buyout. And I think it's done maybe every 2 or 3 years. So I'd encourage Kim to take a look at that if you're just looking for some general market performance data on the diverse and emerging manager market.
Yeah, and if you're an LP, I don't know your role, Kim, but if you're an LP, we're happy to speak to you and share with you our experience as well as a proxy for performance, given the multiple decades of data we have.
And the next question is around how can we get in touch with Fairview to ask more about resources, firm evaluation? Is it okay to share emails? Absolutely. What we'll do is we'll share our email addresses so that you can reach out to either Akar, myself, and Kwesi.
Mm-hmm. And they're actually on our website. We have an open door, so just feel free to reach out. Yeah.
Great. Another question, could you clarify the parameters you use to determine a minority-owned fund?
Sure. So our definition is probably one of the strictest definitions in the marketplace, but our definition is essentially at the management company level, a firm that is women or minority owned, that being at least 51% or more. So if the management company is at least 51% women or minority owned, that's our definition for how we categorize a women or minority owned firm in this data.
Yeah, I think that's a key point there. That's the case for this data. We do work with LPs where there's different definitions, but with lower thresholds on the ownership or none sometimes. But that's the definition for the report.
Thanks for that. Next question is from Eric. Are you seeing diversification in emerging manager strategies, looking at emerging regions like Africa?
Yeah, I mean, Africa, is a really interesting market. It is almost the entirety of the market is emerging managers with hundreds of firms, and there's been a lot of new firm formation. So it certainly makes sense. There's a lot of obviously, positive demographic trends, et cetera, that make it an attractive market, and it's a really diverse market, right? Over 50 countries. So we do see the opportunity there. Unfortunately, I don't think that there has been a major shift in allocating capital specifically for Africa. I think there is a high perception of risk. We find a lot of LPs are looking for like an Africa risk premium on the investments and stuff like that. So I think there's work to be done on kind of educating the market on the real opportunity and risks in Africa. But I would say relative to 5 to 10 years ago, there's certainly more activity. But I think relative to where the opportunity set is today, there ought to be more.
Okay, great. We have another question. Do you have a view on the growing consensus that only mega VC funds will perform?
Okay. I think Akar and I are chuckling because we don't share that view at all. But yeah, I mean, there's a lot of chatter. There's a lot of perceived safety, that Akar spoke to earlier. But in our experience, VC doesn't really scale. There's a handful of VC firms that can do well raising billion-dollar funds. But when you think about being able to connect with founders, being able to help them, you need to be able to be focused. And smaller funds allow you to do that. Smaller funds are typically run by fewer people. They have more skin in the game. And just when you look at simply the law of numbers, it's much easier to 3x a $100 million fund than a $1 billion fund. So we don't share in that view. we have a bias towards, smaller early stage funds.
Oh, thank you for that, Kwesi. And I know Alexa's husband, Alvarez, given the significant growth in women and minority-owned firms over the last decade, how can talent and recruitment partners strategically support these emerging and diverse managers in overcoming some of the key challenges they encounter?
Yeah, I think it's a good question. We see there's probably opportunities to work with these firms both at the firm level as well as their portfolio companies, because these are all entities that are growing and that need talent to support that growth. I think, strategically, I would say that there tends to be a preference to want to work, with younger people that are more reflective of, the demographic trends in the country. And so there's probably an opportunity to help, uncover talent that maybe is overlooked. That probably is an area. But then talent in general, I think, has just become, it's a competitive market. Obviously, the unemployment rate is pretty low. So helping these firms find talent that is maybe also not aware of the opportunity, right, to work with these smaller, newer firms that are often below the radar, that is also another opportunity. So I think it is probably an area worth spending time on.
Thanks for that, Akar. For Margaret, how relevant is the venture studio category to your thesis?
I can take that. We tend to shy away from it, unfortunately. I think there are merits to that model. The challenge we have is compatibility with our model, which is a fund of funds, which we have a term to our funds, and usually venture studios kind of mean that you're investing at the absolute earliest stages of company formation, meaning typically the time to exit tends to be the longest. So that is a challenge, and we find that the best studio models, have to, even the best ones have to overcome some of these challenges around potential adverse selection around talent. And so we have seen some that we really like and that have solved for this, but it hasn't been a great fit for our model. But we have seen great returns come out of it. So I think it makes sense for some GPs, if that's kind of their expertise, and it may be a good fit for some LPs, depending on their model.
Thanks, Ricari. With 1 minute left to go, do you want to go into closing remarks?
Yeah, I think, I mean, we're not going to get to all these questions. There's a lot, as suspected. So what we'll do is, as we did last year, like I said, we'll follow up directly to the people that ask questions that we didn't get to, either via email, or we can set up time to talk. Like we said, we have an open door policy. Our emails are on our website. Feel free to reach out if there's anything we can be helpful with, and that goes for LPs and GPs. And with that, just on behalf of Kwesi, Michelle, Jay, Daniel, who's an analyst on our team that helped put together a lot of this data, as well as the entire Fairview team, just want to thank everybody for participating today in this really important conversation. And we look forward to engaging with you again soon. Thank you.
Thank you.
Thanks, everyone.
Bye-bye.